I do want to talk to you about some of the work you're doing over climate change. I just want to begin with the price action we've seen over the last 24 hours because it's been absolutely phenomenal. What's been your takeaway in the past day, the past week, the past month?
Yeah, great to be here, John. Thanks a lot. Yeah, the real rate story you've been talking about that extensively is a huge deal. I mean, this is at the heart of how we think about the asset allocation going forward. We've been turning downgrading global the DM debt this week, and I think in the context where we think the restart and the vaccine rollout and so on is going to be a very powerful force that is underappreciated. So we think that has more to go in terms of driving rates higher to some extent, but that's in the context where we think we're in a new nominal, where there's going to be pretty powerful force from central banks to prevent too abrupt an adjustment in rates. So we've seen this week, this is pretty painful, but we think that ultimately central banks will be a pretty powerful force to prevent that from adjusting too quickly. So that leaves us pro-risk in this environment, seeing some opportunities when things like yesterday happened. We're still in the same kind of new nominal environment in our view.
Just add to that, if you can, Jean, pro-risk, because I know the team actually downgraded credit earlier this week. So I'm trying to understand where you take the risk, one, and two, how you offset it, given what we've seen happen with duration throughout the whole of this week.
So pro-risk is we favored equities, global equities overall. So we are still like overweight U.S. equities. We have upgraded European equities to neutral this week, and we see also important opportunities in EM equities. That continues to be the case, and Asian debt in particular. So that's the place where we would see the expression of the pro-risk, and then at the same time, as I said, we wanted to position differently in the rate space, more explicitly downgrading DM debt, and in particular going a bit deeper in downgrading U.S. treasuries in that context.
Does this mean a bigger cash position, Jean?
No, I think we are at this stage. We should put money to work. We still think this is a constructive environment for risk. And as I said, I think the restart dynamic is pretty powerful, not fully appreciated. I think there's still a business cycle lens being applied to this environment where we think it's wrong. We think it's not a recovery, it's a restart. Yeah. There's a lot of pent-up demand. We've got the personal income report today in the U.S. and a lot of excess savings that we think will be deployed. So that's the environment that continues to be the one that we think is favorable for risk.
20% savings rate, 10% income, just amazing.